Is debt that hairy, scary thing that we all need to shy away from? What if we told you that we 10x our wealth using debt as jet fuel? And in this episode, we're going to challenge your perception and equip you with a smart strategy so you too can turn your debt into a powerful asset. Before we do this, we need to first talk about an old-fashioned spaghetti western film starring Clint Eastwood called The Good, the Bad, and the Ugly. This phrase really transcends the title of an old spaghetti western. In fact, you can also use this to exemplify the distinction between the different type of debt. You see, most people are familiar with bad debts and ugly debts. These are debts that come with high interest rate, poor purchasing decisions, and often leads to financial strain and sleepless nights. When you hear your grandma running, screaming every time you mention taking on debt, this is probably what she was thinking about. And guys, it's not her fault. The news, the school really rarely talks about other forms of debt. They truly paint a broad stroke when it comes to what debt is, and this leads to a very tainted perspective on debt. With that being said, we think it's not really smart to max out your credit card to do an Instagram Lux weekend escape that you can't afford. Let's avoid that one. However, we're a strong proponent of smartly using good type of debt as a major leverage for your growth, and we definitely did this on our way to 10xing our wealth in real estate. Today, a lot of people know us for acquiring more than $300 million in multifamily portfolio in just 5 years. However, just 5 years ago, we didn't have a large pile of cash that we can throw at an investment. In fact, back then, we were still licking our wounds from our demise of our fashion business, but we knew we wanted to get into multifamily apartments. We just didn't have millions of dollars in the bank to pull it off. So what did we do to make it happen? Before we break this down, let's make this one point first. What determines good debt is like the holy trinity in Cajun or Creole cooking. With these type of meals, you typically put in bell peppers, onions, and celery. These ingredients are sauteed together and serve as a flavor base for many regional dishes like gumbo and jambalaya. Like the Cajun holy trinity, there are probably 3 major things you need to consider as part of any debt strategy: the term, mortgage affordability, and exit plan. Through this lens, we will review our debt structure. Let's break it down. 5 years ago, we started our multifamily apartment investing journey with 0 apartment in our portfolio. We had a small amount of money, too small to think about millions of dollars in property purchase. We had no wealthy parents, uncle, or rich friends to rely on, but we had the hunger to succeed. And that's when we acquired our first multifamily apartment, a small property, 76 units with a purchase price of $6.9 million. After that, in 2020, at the thick of COVID-19 pandemic, we purchased a 100-unit apartment for $6.2 million. Then in 2021, we did 3 larger acquisitions: $16.9 million, $32.7 million, and then $29.4 million. The bigger leap came in 2022 when we made a huge $68 million acquisition. This was only to be topped by an even larger purchase in 2023. That was when we acquired a $77 million apartment complex. With all these large acquisitions, 3 of these deals have actually gone full cycle, aka sold in an average of 25 months of ownership. And with this good debt that we took on, we made a boatload of money. You can see now that with our latest acquisitions, we have more than 10x our portfolio in the last 5 years. And it was only possible with one word: debt. Debt never scared us because we're always evaluating debt on our deals through 3 major lenses. Now, we're not saying to haphazardly rack up debt left and right. It's about making smart decisions and putting your debt to work for you. Think of captaining your ship through choppy waters. You need to steer with confidence and skill to navigate to a place of safety. And that's your role as the borrower. This means fully understanding your loan terms, being clear on the interest rates, and having a solid plan for repayment. So let's dive into what that looks like in one of our recent acquisitions. So we purchased a $77 million apartment complex. For this purchase, we raised around $38 million of capital from our passive investors, and the rest was funded through a loan from HUD, or the Department of Housing and Urban Development. The loan on this apartment complex was around $44 million. We raised a bit extra for working capital and reserve. Okay, so you can see that on the first lens here is understanding the loan term. This was a loan assumption, meaning that instead of taking out a new loan, we were able to take on the existing loan from the seller. By doing this, we are able to benefit from the favorable interest that existing loan has. In this case, the loan was a fixed rate at 3.49% with 38 years of amortization left. Keep in mind that during this time, should we get a new loan, the interest rate would be around 7 or 7.5%. And on a $44 million loan, the difference is over $1.76 million per year in mortgage payment, which automatically translates to additional cash flow for our passive investors. So this was definitely a really beneficial loan, and this helped with our cash flow predictability as well as our expense management because we know exactly what our mortgage payment is. Another benefit for having a fully amortized loan, meaning that from the start, we are paying the mortgage on both the principal and the interest. Well, we say we, but we're actually not the one paying the mortgage, right? It's our tenants. So our tenants are helping us pay the mortgage, reducing our debt while growing our equity. Such a beautiful thing. I agree. Now, we've already touched on the second point that determines whether a debt is a good one or not, and it's debt servicing aspect or our ability to pay the debt. Guys, you want you to remember this point. New and experienced investors tend to run away from a good deal because they are afraid of the current high interest rate. But here's the thing, if you properly account for your debt, then the cost of money is truly irrelevant. In our case, our loan came with a high level of certainty because it's a fixed rate loan with a 38 years loan term. We're able to easily punch in the loan amount, the interest rate, etc. into our investment analyzer, and this projects if the property will have enough net income to support debt service, aka the mortgage on the property. For our investment tip of the day to all our investors out there, make sure that your net income goes well beyond your debt service because this will be considered cash flow. Always make sure that your loan term is in alignment with your business or your investment plan. Without that alignment, you may be stuck in a deal that you can easily sell earlier otherwise. As you're on your way to create your own 10x wealth in multifamily, it's very important for you to assemble a winning team to help you achieve your results. So go ahead and watch this video on Winning Formula Assembling an Apartment Sponsorship Dream Team.